Welcome back to The Explainer, everyone. Today, we're diving into something really fascinating, and that's the evolution of the accountant. For the longest time, the world has viewed accounting as this very traditional, historical number crunching exercise. It's kind of like driving while only looking in the rearview mirror to see what happened last year. But today, we're going to explore how that role is fundamentally shifting. It's moving right into the dynamic, forward looking world of strategic business leadership. We are literally moving from just balancing the books to actually steering the ship.
Here's a quick roadmap of what we're covering today. First, looking back at financial analysis. Second, looking forward to strategic accounting. Third, dreaming versus doing with mission and vision. Fourth, defining competitive business strategy. And fifth, the strategic planning process. Let's jump right in. Okay, part one. Looking back, financial analysis and evaluating the past. Traditionally, the main goal of a business is to make the owners wealthier, right? To figure out if they actually pulled that off, we look at historical financial statements. We take all that past data, pull it apart, and convert it into a format we can actually use to evaluate the business and see if management's past decisions were actually effective. But you might be wondering, why do we scrutinize the past so heavily?
Well, that brings us to a massive, absolutely critical concept: risk. Simply put, risk is the probability that an expected outcome will not be realized. You see, the whole point of digging through historical financial information is actually to forecast the firm's ability to maximize future earnings. But here's the catch: the future is completely uncertain. Say you invest in a business expecting a 15% return. The risk is that unexpected things happen, like maybe operational disasters or totally crippling debt interest, that actually stop you from getting that return. We literally look at the past to try and figure out the probability of success in the future.
And it's definitely not just the owners and investors who are sweating over these numbers to assess risk. There is a massive array of stakeholders who rely on this traditional financial info. Suppliers want to know if you can actually pay your bills. Employees want to know if their jobs are safe. Auditors, tax authorities like SARS, customers, regulators, they all scrutinize these historical numbers. This just goes to show how fundamentally important traditional financial analysis really is. It's the absolute bedrock of business transparency.
Moving on to part two: looking forward, strategic accounting, the paradigm shift. While understanding the past is super important, modern businesses are operating in these wildly complex, fast-paced environments. So our story takes a big turn here as we move away from traditional accounting and step into strategic management accounting, or SMA. Which leads me to ask you this kind of provocative question: is historical financial data enough to survive in a dynamic market? I mean, think about it for a second. If you're only ever looking in the rearview mirror, how on earth are you going to navigate the roadblocks that are coming up right in front of you? Relying only on internal financial targets and past performance leaves a company incredibly vulnerable to sudden market disruptions, fierce new competitors, and shifting customer needs. So the answer to this question? It's a hard no. Let's put these two approaches side by side to really see the difference. Traditional management accounting is strictly about internal operations, historical data, and hitting financial targets. It's highly focused on internal decision-making. But strategic management accounting, that emerges as the forward-looking hero of our story. SMA is tied directly to the corporation's actual strategy. It actively monitors external changes in the environment, and, this is crucial, it uses a mix of both financial and non-financial data. It's essentially modern performance management in action. All right, part three: dreaming versus doing, mission and vision. If we're really going to adopt this forward-looking strategic approach, how do we actually build that strategy? Well, before a company can map out total market dominance, it needs a North Star. Let's clear up some corporate jargon that gets mixed up all the time. Vision and mission. They are not the same thing. The vision statement is the dreaming part. It's an inspiring, super concise declaration of what the company wants for the future. It's where the organization ultimately wants to end up. The mission statement, on the other hand, is the doing part. It lays out actionable, everyday goals. It's what the company is actually executing on a Tuesday afternoon to inch closer to that big dream. Let's actually play a quick matching game to make this super clear. Take a look at these massive household names. McDonald's says their goal is to make delicious, feel-good moments easy for everyone. That is something they do every single day. So that's a mission. The Alzheimer's Association wants a world without Alzheimer's. That is a massive, future-focused dream, so that's a vision. Disney aims to entertain, inform, and inspire people around the globe. Again, that's their daily grind, a mission. Microsoft is actually a fantastic example of having both.
Their original vision was a personal computer in every home, which was the dream, while their mission is to help people realize their full potential, which is the doing. And Google? To organize the world's information and make it universally accessible. That is pure, actionable mission. Part 4. Defining competitive business strategy. The master plan. Okay, so we've got our mission and vision dialed in, but how do we actually go out there and win in the marketplace? Let's take a look at how 3 leading authorities define strategy. First up, we have a totally foundational quote from the absolute legend of strategy, Michael Porter. He defines strategy as the unique way in which the company, its products, services, or strategic business units serves the specific needs of its customers. It is the source of long-term, sustainable competitive advantage. I want you to really plant a seed in your mind right now regarding the specific phrasing he uses here. Next, let's hear from academics Johnson, Scholes, and Whittington. They put it like this. Strategy is the unique direction and scope of an organization over the long term to achieve sustainable competitive advantage through the configuration of resources within a changing environment. Now, pay close attention to the overlapping vocabulary in this definition compared to Michael Porter's.
And finally, our third quote from Leifley and Martin. They say, strategy is an integrated set of choices that uniquely positions the firm in its industry so as to create sustainable advantage and superior value to the competition. Okay, I am sure you've spotted the exact pattern echoing across all 3 of these expert quotes by now. Did you catch it? The huge, absolutely unforgettable takeaway here is unique and sustainable competitive advantage. Strategy is definitely not just a fancy to-do list. It is all about finding a position in the market that is totally unique to your firm, and then building an advantage over your competitors that is actually sustainable over the long haul. If your grand plan doesn't do those 2 specific things, it's not a strategy, it's just a tactic. Part 5. The strategic planning process, putting it all together. You see, you can't measure uniqueness and long-term sustainability just by glancing at last year's inventory costs. We need a highly structured approach to put this master plan together. Now, I know what you're thinking. This flowchart from Johnson, Scholes, and Whittington looks totally overwhelming at first glance. It's got everything flowing from mission and vision all the way down to review. But don't panic, we're going to break this whole thing down together. Let's make this easier and chunk that dense flowchart into 4 clean, simple steps. Stage 1 is strategic analysis, which is basically figuring out exactly where you are right now. Stage 2 is strategic choice, identifying and picking your absolute best options. Stage 3 is implementation, taking that chosen strategy and actually doing it. And Stage 4 is review and control, monitoring your performance so you can learn lessons for the future. To bring this whole thing full circle, back to the very beginning of our explainer, let's zoom in on just that very first step, strategic analysis. Doing this right requires examining your internal realities, like your strengths and weaknesses based on your financial performance, but also your external circumstances, like big market opportunities and looming threats. This perfectly illustrates exactly why strategic management accounting requires an external, forward-looking focus, mixing up both financial and non-financial data. You literally cannot do proper strategic analysis if you are only staring at internal historical numbers. And that brings us to the end. So are you ready to evolve from just crunching numbers to actually leading the strategic vision of a business? Understanding historical financial data is absolutely a foundational superpower for sure. But applying these strategic frameworks, that is how you create sustainable wealth and actively shape the future. I really hope this explainer has left you super eager to step out of the past, embrace the whole external environment, and become a true strategic leader. Keep learning, stay focused, and we'll catch you in the next one.